Welcome back to Investing Talk podcast. We are here to shortcut your research and bring the most critical analysis from the market this week.
And today, we're taking a close look at Eos Energy Enterprises. They're a grid-scale energy storage provider.
Right, and this is a name known for, well, pretty extreme volatility, isn't it? Lots of promises around non-lithium storage.
Exactly. Big promises, big swings.
So you came to us with a stack of research asking that key question. Is Eos Energy Enterprises a good time to buy now? We've synthesized the latest reports, financials, technicals, market talk to give you that quick, informed perspective.
And before we really dive in, maybe a good time to remind everyone.
Oh, right! Please hit that like button, subscribe if you haven't, and definitely leave us a comment. We love hearing from you.
And if there's a specific company you want us to look into for a future segment, just, drop the name in the comments below.
Okay, let's get into it. Eos Energy Enterprises. It really feels like a story of two extremes, doesn't it?
Yeah.
You've got this huge market potential on one side, and then, frankly, some pretty concerning execution on the other. Let's start with the potential, the attractive part. What makes this tech interesting?
Well, the appeal is definitely there, and it's all about the technology itself. Eos uses their own proprietary zinc hybrid cathode battery. They call it Zenith.
Zenith, okay.
Yeah, and for utility-scale storage, the idea is that it's a big step up from lithium-ion. It's non-flammable, which is a huge safety point.
That's a big deal, yeah.
And it uses materials that are easy to get, like zinc. Plus, it potentially offers longer duration storage, think, 4 to 12 hours, which grids increasingly need.
So better safety, easier materials, maybe longer performance for utilities. And you mentioned regulatory tailwinds helping too, like the Inflation Reduction Act.
Absolutely. That context helps the whole sector. And the market does seem to want this specific solution. The demand isn't just theoretical.
Right. You pointed out that backlog number.
Exactly. They reported a pretty substantial $561 million energy storage system order backlog at the end of 2024.
Wow. $561 million.
Yeah, and that's not just, wishful thinking. It represents real market validation, actual contracts from big players looking for this non-lithium option.
Okay, $561 million. That's a huge number. But then you look at the revenue they actually brought in for 2024.
Only $18.88 million.
Right, and that massive gap. That's where the tension really builds in the story, isn't it?
Right.
We see the demand, the marketing potential, but now we need to look under the hood. Let's talk financials.
Yeah, and, the financial reality is pretty brutal, honestly. Despite that huge backlog, the net loss for fiscal year 24 was $218.1 million.
Oof. Over $200 million loss on less than $19 million in revenue.
It's stark. Revenue conversion from that backlog is just incredibly slow. Costs are high. And maybe the most critical takeaway here is that the gross margin is still deeply negative.
Why is that? Still just manufacturing costs?
Primarily, yeah. They just don't have the production scale yet, and manufacturing this unique scythe of tech is expensive right now. The bottom line is they've never, ever posted an annual profit.
Okay, hold on. If they have over $500 million in signed contracts, shouldn't that backlog act as collateral? Why can't they get, decent debt financing instead of just selling stock?
That is the core question, and it really highlights the risk profile here. The market, the lenders, they seem to view that backlog as high risk.
Because they haven't proven they can deliver on it consistently.
Exactly. That, combined with their really fragile cash position, they ended 2024 with only $39.9 million in cash. That's way down from $64.3 million the year before.
And the cash burn rate. This was the number that really jumped out from the reports you sent.
Yeah, it's staggering. They burned through $145.3 million in operating cash just last year, just in operations.
So let me get this straight. They have under $40 million in cash, but they're burning through nearly $150 million a year just running the business.
That's the math. It means they are operating on an incredibly short runway, burning cash almost 4 times faster than they ended the year with. And you see that structural weakness confirmed elsewhere too, like the negative shareholder equity. It's sitting at a $47.4 million deficit.
Okay, for people maybe less familiar with balance sheets, how bad is negative shareholder equity for a company like this, one that's still technically pre-profit? Are we maybe being too tough on the losses?
Well, losses are definitely expected in a growth phase, no doubt, but negative equity. That means the accumulated losses have literally wiped out all the capital shareholders initially put in, and then some.
So it underscores the dependency.
Totally. It reinforces that management, keeping the lights on, keeping operations going. It's entirely dependent on bringing in external capital. And their main tool for that seems to be these highly dilutive ATM offerings at the market stock sales.
Which just means selling more and more stock into the market, pushing the price down for existing holders.
Precisely. It can create this nasty dilution spiral, puts constant pressure on the stock price and existing investors.
Okay, so the narrative is clashing hard here. Great product idea, clear demand, but the finances are precarious, and capital efficiency seems non-existent. Let's pivot to operations. Why can't they execute on that huge $561 million demand? What's the bottleneck?
It really seems to boil down entirely to manufacturing and logistics.
Mm-hmm.
If you look historically, converting that backlog into actual revenue has just been painfully slow.
Repeated delays, you mentioned.
Yeah, repeated delays, and they seem really constrained by their production scale. Simply put, they're not building the batteries fast enough, or maybe cheaply enough yet, to actually service those big contracts effectively.
All right.
That's basically the textbook definition of high execution risk.
And it's not like they're operating in a vacuum. They're up against giants who've already figured out mass production.
Exactly right. The competitive landscape is, frankly, brutal. It's dominated by established lithium-ion vendors, and you have to mention Tesla Energy specifically.
Right. Tesla has the scale, the supply chains.
Massive economies of scale, mature supply chains, much lower manufacturing costs, presumably. EOS is still really struggling to make that leap from being a cool development story to being a high-volume commercial producer.
Any other operational risks?
Well, there's also significant customer concentration risk. A really big chunk of that impressive $561 million backlog comes from just one or two large clients.
So if one of those deals goes sideways.
It magnifies the risk considerably, yeah. If a key relationship sours or a big project gets delayed further, it has an outsized impact.
Okay, let's switch gears to the stock chart itself. You flagged this one partly because it's so volatile. It pops up a lot as a short squeeze candidate, makes these sharp speculative moves.
Definitely.
You noted that just in the last month, September 2025, it swung wildly between, what, $7.40 and $10.40.
Yeah, big swings. For an active trader, maybe those spikes are tempting, right? But the underlying technical picture tells a different story about sustainable strength.
So what are the charts telling us?
Well, the technicals really reinforce that this is, for now at least, a purely speculative play. It's not really showing an investment trend. Since around May 2025, the overall price direction has been sort of sideways to maybe slightly downward, but with that extreme volatility layered on top.
And the moving averages.
Yeah, if you connect that to the bigger picture, the gap between the key moving averages is pretty telling. The 200-day moving average, which reflects the longer-term trend, is sitting up around $11.90.
Okay.
But the 50-day moving average, the shorter-term trend, is way down around $8.70.
And what does that wide gap, that spread, signify, especially for a stock with this kind of meme stock reputation?
It strongly suggests that the longer-term forces, maybe institutional selling or just general bearish momentum, are consistently overpowering any of those short-term speculative rallies. You know, the ones often fueled by retail chatter on social media.
So the quick pops don't seem to be sticking.
Right. The market, broadly speaking, just doesn't seem to believe in the underlying strength at these levels right now.
Yeah.
And you see that confirmed with indicators like the MACD, which remains negative. It reinforces that lack of underlying momentum.
And this technical weakness, it seems to be mirrored by what the insiders, the leadership are doing. You flag some sales there.
Indeed. That always warrants a close look. We saw multiple directors and executives trimming their positions recently.
Like who?
Well, for instance, Director Marian Walters sold around 50,000 shares just this month, September 2025. And the CFO sold a pretty significant chunk, almost 100,000 shares, back in July.
Nearly 100K shares by the CFO.
Yeah. And when the people who are closest to the day-to-day operational reality are consistently reducing their holdings, well, it strongly suggests they see the current stock price more as an opportunity to take some money off the table, rather than, say, a reflection of imminent exponential growth.
It definitely raises questions about their confidence at these price levels, doesn't it?
It does. Adds another layer of caution.
Okay, so wrapping that section up, we've got fundamentally weak financials, serious execution challenges, very high volatility driven by speculation, and insiders signaling caution. What's coming up? Are there any near-term events that could dramatically swing this stock one way or the other?
Yes, there's a really critical one just around the corner. The special shareholder meeting scheduled for October 16th, 2025.
And what's that about?
This is highly binary, as they say. Shareholders need to vote on approving a new issuance of common stock.
Which is basically a vote on whether to allow the company to sell more shares to raise cash,
Yeah.
keep the lights on, stay listed on Nasdaq.
Precisely. That's what it boils down to. If the proposal passes, okay, the company gets a much-needed capital lifeline. But the trade-off is immediate, ongoing dilution for everyone else.
If it fails.
If it fails, the company faces an immediate, pretty acute liquidity crisis. That changes the narrative completely and likely not in a good way for the stock price.
So a really high-stakes vote. What else?
Well, following that meeting, we'll have the Q3 earnings report probably sometime in November 2025.
And investors will be laser-focused on.
Two main things, I think. First, the cash runway. How much time does the latest capital, if approved, buy them? And maybe even more importantly, any commentary from management about tangible progress. Are they actually starting to convert that massive $561 million backlog faster?
They need to show something concrete on execution, basically.
Absolutely. The pressure is really on management to prove their path to scaling production is getting shorter, or that liquidity concern just gets deeper and deeper.
You also mentioned analysts are all over the place on this one.
Yeah, it's worth noting the analyst community is completely mixed, which probably adds to the volatility and confusion. We saw downgrades like from Wall Street Zen back in August.
Right.
But then more recently, firms like Guggenheim and Stifel Nicolaus actually upgraded their price targets to $10.
Huh. Upgrades to $10 even with all these issues.
Yeah, shows the conflicting institutional sentiment, which definitely helps fuel those big price swings we've been seeing.
And then looking further out, longer term, what are the speculative hopes?
Long term, it really comes back to two main things. Can they finally fulfill that huge backlog? And second, does the technology itself become an attractive acquisition target for a bigger player if, and it's a big if, they can actually demonstrate they've figured out scaling?
Okay, so let's try to synthesize all of this. If we summarize the mountain of info we just went through, the big risks are?
The major risks feel pretty acute right now. First, execution failure, just not being able to build and deliver efficiently. Second, liquidity concerns, the constant need for cash forcing, ongoing dilutive financing. And third, that heavy dependence on capital markets, which right now seem more fueled by speculation than fundamentals for the stock.
So bringing it all together for you, the listener, asking that original question, is now the time to buy Eos Energy Enterprises? Based on this analysis, we have to be pretty direct about the risk profile, don't we?
I think so. Our analysis shows the fundamentals are, well, structurally flawed at the moment. You've got persistent losses, those negative gross margins, and really no clear, visible path to profitability in the near term. The balance sheet is fragile, and it demands continuous dilution just to keep operating.
So based on that, thinking about it as a long-term investment grounded in fundamental strength, it's just not recommended right now, is it?
No, I don't think you can make that case. The risk of continued dilution is very high, and the company's track record on execution just makes it an unsuitable proposition for a long-term hold based on current data.
How would you categorize the stock then?
I'd categorize it as purely speculative. It seems only suitable for very experienced traders who understand the risks and are essentially gambling on short-term events.
Like betting specifically on a yes vote at that October 16th shareholder meeting.
Exactly.
Yeah.
Or hoping for another brief short squeeze pop. It's event-driven trading, not investing based on sustainable business fundamentals as things stand today. But maybe here's a final provocative thought for you to chew on. That $561 million backlog. It is concrete proof that there's real market demand for what Eos Energy Enterprises offers for their non-lithium technology.
The demand is there.
The demand is definitely there. So the ultimate decision for any potential investor really has to come down to this. Do you genuinely believe this company can make the incredibly difficult transition from being a development story, a potential story, to being a real production at scale enterprise before their current cash runs out?
That's the race against time.
It is. The market clock seems to be ticking a lot faster than their production line right now.
A perfectly summarized risk-reward equation right there. Thank you for tuning into Investing Talk podcast. We appreciate you listening.
Yeah, thanks everyone.
We'll catch you next time for our next segment.